Money, the greatest invention that changed the world. Imagine you have fish, but you need shoes. The shoemaker doesn't want fish, he wants wheat. Now you must find a farmer who wants fish, and who also has wheat. Complicated, right? This was life before money. Money is one of the most powerful inventions in human history. It built empires, caused wars, created billionaires, destroyed economies, and today it even exists as invisible digital code. But, who invented money? How did it start? Why does it control the world? And what might replace it in the future? Let's travel back thousands of years and uncover the story of money. What is money? Money is anything that people agree has value and can be used to buy goods and services. To truly be money, something must do three things. 1. Medium of exchange, used to buy and sell. 2. Store of value, keeps value over time. 3. Unit of account, allows us to measure value like $10, 500 rupees or 20 euros. Today, we use dollars, euros, rupees, yen, but money hasn't always looked like this. Before money, the barter system. Before money, people used barter. You give me wheat, I give you milk. But barter had a huge problem. The double coincidence of wants, both people had to want what the other had. This made trade slow and inefficient. Fun fact, some ancient cultures used cows as currency. The Latin word for money, pecunia, comes from pecus, meaning cattle. Barter worked for small villages but not for growing civilizations. Humans needed something better. The first forms of money. Commodity money. Early humans began using items that everyone valued. Examples: salt, shells, beads, tea, tobacco. In parts of Africa and Asia, cowrie shells were widely used. The first metal coins, around 600 BCE, something revolutionary happened in the Kingdom of Lydia, modern-day Turkey. The Lydians created the first standardized metal coins. Their king, King Croesus, became so wealthy that his name became a symbol of riches. Coins were made from electrum, a natural mix of gold and silver. Why coins were powerful? Because they were durable, portable, hard to fake, universally accepted. This changed trade forever. Fun fact, the phrase, as rich as Croesus, still means extremely wealthy, over 2,500 years later. The birth of banks. As trade expanded across cities and continents, a new problem appeared. Gold and silver were heavy, dangerous to transport, easy to steal. Merchants traveling from one city to another risked losing everything to thieves. Humanity needed something safer, and that's when banks were born. Where the word bank comes from. The word bank comes from the Italian word banco, meaning bench. In medieval Europe, money changers would sit behind wooden benches in marketplaces. People would bring foreign coins, and these money changers would exchange them for local currency, for a small fee. If a banker failed and couldn't pay back deposits, his bench would be broken. That's where the word bankrupt comes from, bancarotta, broken bench. Fun fact, the concept of bankruptcy literally comes from smashing a banker's desk in public. Early banking in ancient civilizations. Banks didn't start in Europe. They go much further back. Mesopotamia 2000 BCE. In ancient Mesopotamia, temples and palaces acted like banks. Priests stored grain and precious metals for people. They accepted deposits, gave loans, charged interest. The Code of Hammurabi even included rules about loans and interest rates. This means banking regulations existed over 3,800 years ago. Ancient Greece. In ancient Greece, moneylenders called trapezitai operated in marketplaces. They exchanged coins, stored deposits, provided loans to merchants. Temples were considered the safest places to store wealth. Ancient Rome. The Romans advanced banking further. Roman bankers transferred money between accounts, financed businesses, funded construction projects. They even had something similar to checks. Rome built a complex financial system that supported one of the largest empires in history. The rise of medieval banking. After the fall of Rome, banking slowed down in Europe. But as trade revived in the Middle Ages, banks became essential again. Merchants trading silk, spices, and precious goods across continents needed credit. Currency exchange, safe storage. This led to the rise of powerful banking families. The Medici Revolution. In 15th century Florence, the Medici Bank became one of the most powerful financial institutions in Europe. Founded by the Medici family, it created international banking branches, developed accounting systems, financed kings and popes. One member of the family, Cosimo de' Medici, used banking wealth to become one of the most influential figures in Florence. The Medici didn't just finance trade, they funded the Renaissance. Artists like Michelangelo and Leonardo da Vinci were supported by wealthy banking families. Banking literally helped create art history. The birth of modern central banking. As nations grew, governments needed money to fund wars and infrastructure. This led to the creation of central banks. One of the most important was the Bank of England, founded in 1694. Its purpose, to lend money to the government. It introduced national debt systems, government bonds, centralized currency control. This became the model for modern central banks around the world. Today, almost every country has one. Examples include the Federal Reserve in the United States, the European Central Bank in Europe. These institutions control interest rates, money supply, inflation. They influence the entire global economy. How banks actually work. Many people think banks simply store money, but banks actually do something more powerful. They lend it. When you deposit $1,000, the bank keeps only a fraction and lends out the rest. This is called fractional reserve banking. It allows banks to create credit, expand the money supply, stimulate economic growth, but it also carries risks. If everyone demands their money at once, that's called a bank run. And history shows bank runs can collapse entire economies. The dark side of banking. Banking has also caused major crises. The Great Depression of 1929 saw thousands of banks collapse. More recently, the 2008 financial crisis showed how interconnected and fragile global banking can be. Huge institutions failed, governments intervened, and economies slowed worldwide. Banks are powerful, but power requires trust. Without trust, money loses its value. Why banks changed the world? Banks made it possible to fund exploration, finance industrial revolutions, build skyscrapers, launch corporations, support startups. Without banks, global capitalism would not exist. They transformed money from simple coins into a complex financial system. Fun facts about banks. The oldest surviving bank in the world is Banca Monte dei Paschi di Siena, founded in 1472. The first ATM was introduced in 1967 in London. Banks create most of the money in modern economies through lending, not governments. The largest banks in the world manage trillions of dollars, more money than the GDP of many countries. From temple vaults to Renaissance families, from broken wooden benches to global financial empires, banks didn't just store money, they shaped civilization. And today, as digital finance and cryptocurrencies rise, the role of banks is being questioned once again. Is traditional banking evolving, or being replaced? That's a story still unfolding. The end of gold and the rise of fiat money. What was the gold standard? Under the gold standard, a country's currency was directly linked to gold. Governments promised that paper money could be exchanged for a fixed amount of gold. For example, under the Bretton Woods system, 1944, the US dollar was pegged to gold at $35 per ounce. Other countries pegged their currencies to the US dollar. This made the dollar the world's reserve currency. It created stable exchange rates, limited money printing, confidence in currency, but it also created major limitations. Why did the gold standard collapse? 1. Economic growth outpaced gold supply. As economies grew after World War II, trade expanded rapidly, but gold supply increased slowly. There simply wasn't enough gold to back expanding global money supply. 2. US deficit and Vietnam War. In the 1960s, the United States spent heavily on the Vietnam War. Domestic welfare programs. Countries began converting the dollars into gold. US gold reserves started shrinking rapidly. 3. The Nixon Shock, 1971. Richard Nixon announced on August 15, 1971, that the US would suspend gold convertibility, stop foreign governments from exchanging dollars for gold. This effectively ended the Bretton Woods system. By 1973, the world fully shifted to floating exchange rates. What is fiat money? Fiat money is currency that is not backed by gold or any physical commodity, has value because governments declare it legal tender, is supported by trust in the economy and central bank. Examples: US dollar, Indian rupee, euro, yen. Its value is based on government authority, economic stability, public confidence. Key differences: gold versus fiat. Gold standard, backed by physical gold. Limited money supply, fixed exchange rates, low inflation, constrained government spending. Fiat money, backed by government trust, flexible money supply, floating exchange rates, inflation possible, allows stimulus and QE. Why governments prefer fiat today? 1. Monetary flexibility. Central banks can lower interest rates, print money, stimulate economy during crisis. Example, during the 2008 financial crisis and COVID pandemic, central banks injected trillions into economies, impossible under gold. 2. Crisis management. Under gold, governments couldn't expand money supply quickly during recessions. Fiat allows quantitative easing, QE, bank bailouts, stimulus packages. 3. Supports modern financial systems. Global trade, derivatives, digital payments, and credit markets require flexible liquidity. Risks of fiat money. Inflation. Since money isn't limited by gold, governments can overprint. Examples: hyperinflation in Zimbabwe, Weimar Germany, 1920s, currency devaluation. Excess printing reduces purchasing power. Debt expansion. Governments can borrow heavily since they control currency issuance. Long-term impact of ending gold. 1. Rise of US dollar dominance. After 1971, the dollar remained global reserve currency, especially after oil began being traded in dollars, petrodollar system. 2. Explosion of global debt. Since fiat allows credit expansion, global debt levels skyrocketed post 1971. 3. Increased market volatility. Floating exchange rates introduced currency speculation and forex markets. 4. Asset price inflation. Real estate, equities, and commodities saw long-term appreciation due to liquidity expansion. Is gold still relevant? Even in a fiat system, central banks still hold gold reserves. Gold is considered a hedge against inflation. Investors buy gold during economic uncertainty. Countries like China and Russia have increased gold reserves in recent years. Big debate: was ending gold good or bad? Arguments for fiat: enables economic growth, allows crisis response, supports modern banking. Arguments for gold: prevents excessive debt, controls inflation, enforces fiscal discipline. How money changed the world. Money allowed global trade. Empires expanded, well-funded massive empires like the Roman Empire to build roads, armies, and cities across continents. Silk roads flourished, money-powered trade along the Silk Road, connecting China to Europe with silk, spices, and gold. Oceans were crossed, investors financed explorers like Christopher Columbus, leading to the discovery of new continents. Industrial Revolution. Factories, capital-funded steam-powered factories in 18th century Britain, transforming handmade goods into machine production. Mass production. Money enabled innovators like Henry Ford to build assembly lines that made cars affordable. Capital investment. Banks financed railways that connected entire nations, shrinking travel time from months to days. Modern economy. Credit cards. Companies like Visa Inc. *** made it possible to buy now and pay later. Loans. Entrepreneurs borrow money to start businesses that create jobs and global brands. Stock markets. Exchanges like the New York Stock Exchange allow companies to raise billions from investors. Money enabled capitalism. Private ownership and profit-driven markets shaped economies worldwide. Global corporations. Multinational giants operate across dozens of countries, powered by international finance. Modern wealth systems, investments, pensions, and digital banking define personal financial security today. It also caused inflation. Printing excessive money once led to hyperinflation in Germany in 1923, where prices doubled within days. Economic crises. The 2008 collapse of Lehman Brothers triggered a global recession. The Great Depression. The 1929 crash of the New York Stock Exchange wiped out fortunes overnight. Financial crashes. Market bubbles like the 17th century Dutch tulip mania showed how speculation can destroy wealth. Fun fact: the largest bill ever printed in the US was $100,000, used only between Federal Reserve banks. Digital money era. Today, most money isn't physical. It's just numbers on screens. Online banking, UPI, credit cards, mobile wallets. Less than 10% of global money exists as cash. The rest, digital, cryptocurrency. In 2009, a mysterious figure named Satoshi Nakamoto introduced Bitcoin. Bitcoin is decentralized, limited supply, 21 million, not controlled by governments. It uses blockchain, a public digital ledger. Now thousands of cryptocurrencies exist. Fun fact: no one knows who Satoshi Nakamoto really is. Who really invented money? Money wasn't invented by one person. It evolved. But key pioneers include King Croesus, standardized metal coins; Chinese merchants, paper money system; Renaissance bankers like the Medici Bank, modern banking foundations; Satoshi Nakamoto, digital decentralized currency. Money is humanity's collaborative invention. The future of money. So what's next? Central bank digital currencies, CBDCs, governments creating digital versions of national currencies. I+ smart contracts, automatic payments triggered by code. Cashless societies. Some countries like Sweden are close to becoming nearly cashless. Fully decentralized finance, DeFi, no banks, just code. Possible alternatives: cryptocurrency, energy-backed currency, reputation-based systems, resource-based economy. Some even imagine a future where money disappears, replaced by automation and abundance. The power of money. Money is power, freedom, security, influence, but it is also debt, inequality, corruption. Money itself isn't good or bad. It's a tool. How we use it determines its impact. Mind-blowing fun facts. The word salary comes from Roman soldiers being paid in salt. Over 90% of the world's money exists only digitally. Banks don't keep all your money, they operate on fractional reserve systems. The first credit card was introduced in 1950 by Diners Club International. Hyperinflation once caused people to carry money in wheelbarrows in Germany in 1923. From cowrie shells, to gold coins, to paper notes, to invisible digital code, money has evolved with humanity. And the next version, it might already be in your pocket, or on your phone, or inside a blockchain. The story of money is really the story of us. Thank you for watching. If you found this video valuable, please support the channel by liking, sharing it with your network, and subscribing for more insightful content. Your encouragement truly motivates us to create more meaningful videos. Looking forward to seeing you in the next one.